So last week we did changes in accounting policy, do you remember? And the changes in accounting policy had that big note where we had to adjust the accounting policy retrospectively, fix our financials, isn't it? So essentially we restate our financial statements so that it looks like we always had that accounting policy, yes? So we restate all our comparatives, and then we do a note where we say what the effect was of that restatement so that the users of the financials can maybe pick up last year's financials and pick up this year's financials and see how it moved and say, oh, okay, yeah, here it was the accounting policy. So today we're going to deal with the other two pieces in that standard. The first one that we're going to look at today is changes in estimate. Changes in estimate are changes that have to do with management's judgments. These estimates are management's judgments. They are not accounting policies. They are judgments that management had to make at some stage regarding something. The most common ones that you're going to come about are life of an asset, residual value of an asset, and depreciation method of an asset. But it could include things like stock obsolescence. It could include things like warranties. It could include things like doubtful debts. Because do you agree, for all of these items, and really for all provision type items, management has to make an estimate. Management has to try and estimate how many items that are sold come back under warranty to be repaired, isn't it? When then they do a provision for warranties. They have to try and determine how many of the debtors won't pay, so they can do a doubtful debts provision. They have to determine how much stock will be obsolete. But predominantly in this module, you're going to see these three. Management has to make estimates about life of an asset, about residual value of an asset, and about the depreciation method. And management has to do those estimates every year. Yeah? There's a requirement in IAS 16 that says that management must reassess every year these three things. So it is common to find that they change. And we're going to deal with today what happens when there's a change in an estimate. Essentially, the rule for changes in estimate is that changes in estimate are prospective. Prospective. If you remember last week, we said changes in accounting policy are retrospective. They go backwards. Changes in estimate are prospective. They go forwards. And because they are prospective and they go forwards, it means we don't have to adjust things going back, isn't it? So therefore, we are only adjusting the current year. We're only adjusting the current year and then future years. So the calculation is a very simple calculation. The calculation for a change in accounting estimate is very simply old and new. And for these three things that I've said to you are the most common, all we're trying to work out is what was old depreciation and what's new depreciation, isn't it? What was old stock obsolescence? What's new stock obsolescence? What was old warranties? What's new warranties? Old versus new. And the difference between old and new is my change in estimate. This change in estimate is disclosed not in its own separate note. The disclosure is in the profit before tax note. And the disclosure is three things. One, descriptive. What changed? Why did it change? Who changed it? When did it change? Descriptive. Descriptive disclosure of what the change in estimate was. 2, the effect in current year. Management changed the useful life of a machine after the machine was damaged. The impact of the change in useful life is an increase in depreciation in the current year of 1,000 rand. And then thirdly, the effect in future years. The impact in future years is that depreciation will be less by 1,000 rand. Do you agree? An asset will be fully depreciated over its life. So if I've increased depreciation this year, it means in future years it will decrease, isn't it? Because I've just reduced the life. There'll be a period where I was going to depreciate, which I won't because I reduced the life. Sometimes that future period impact or effect is not possible to determine, especially with these 3. Yeah? So it isn't possible for us to say what the impact will be in future years of us increasing our stock obsolescence provision. Why? We don't know how much stock there will be in future years, so it's impossible to say, isn't it? But for the first 3, where we're dealing with an asset, we do know what the value of that asset is. We do know what the impact will be in future years, and so we need to put that down. Yeah? So if it's a residual that changes, we can work out what the impact will be in future years. If it's a life that changes, we can work out the effect in future years. So that one is possible to do. All right, so changes in estimate are very easy. We just look at the old and the new. The rule is we go prospective only, so we're only looking at the current year, and the disclosure is in the PBT note at the bottom. Descriptive, impact in current year, impact in future years. Simple, straightforward. All right, the example is in your study guides on page 75. Look at quickly, and then you're going to practice the change in accounting policy in the assignment. So on page 75, it says, Rec Bill commenced business 1 January 09. All right, so I always like to see where we are. We're in December 12. So if I have to draw a quick timeline, December 12 is end of year or year end. December 11 was beginning of year, and they commenced business 1 Jan 09. Okay, which was quite a long time ago. At which date they bought machinery of R1 million. The expected useful life at this stage was 11 years. Machinery is depreciated on the reducing balance method at 20% per annum. Reducing balance, 20% per annum. Would help if... Sorry, let me just do this quickly. I don't know why I have to do it every day. Well, I don't even know if it will help, to be honest. Let's see. Okay, so it's reducing balance method at 20%. During December 12, the directors decided to change this method to straight line. For purposes of this question, you may assume that each year a tax rate of 28% on tax is applicable. Net profit and taxable income earned for whatever is this and this. SARS does not comply with the new method. I'm not even going to talk about tax because these management estimates, SARS never goes with your management estimates. Do you agree? When does SARS ever use your management estimates for anything? Never, ever, amen, isn't it? He never uses your life, your residual, your depreciation method. He has his own wear and tear and his own tables. Your provisions, bad debts, warranties, obsolescence. SARS doesn't look at those, isn't it? What SARS does is he will give you the write-off when it happens, and the only exception is when you write off stock, he lets you write it off, isn't it? But not when it's a provision. And for the bad debts, he gives you 25%. But tax and changes in accounting policy is almost like a non-event. SARS will carry on doing his thing, and you're going to change the way you're doing your thing. Okay. It says that SARS calculated the tax allowance at 20% reducing balance. They've got some dividends that were declared. I don't know what for, but we're going to pretty much ignore those. And so we're going to have a look at what happened with this change in estimate. So if we first of all just look at this life. We bought the asset in Jan 09. Our first year end was December 09. 09, 10, 11. 3 years up to beginning of year. Do you agree? 3 years up to beginning of year. So minus, if we do it in blue, minus 3, we've got 8 years left at beginning of year. Yeah? Our adjustments will always be done at beginning of year. We're going to change this year's depreciation. Okay. If we look at old was, we bought an asset of $1 million in 09. It was depreciated at 20% reducing balance. Do you agree? So I would have taken 200 and been left with 800, and I would have taken 160 and be left with 640. So this is now our years. This is when this was 09, 10, 11. Do you agree? No, it's not. Rather let me undo because now I've rubbed out. This is beginning of 09. This is end of 09. End of 10. End of 11. Do you agree? I just want to see who this is. So 640, 20% is 128, leaving me with a balance of 512, is it? Is it? 512. So I have to get the asset to beginning of year, yeah, using the old method. Now, 1,200 gets me to 800, 160 gets me to 640, 128 gives me to 512. Do you agree with the dates? It's 3 years. We had said 3 years, 09, 10, and 11. Okay, now, if I carried on with old, what's 20% of 512? 124? 102.4. So if I had carried on the old method, that would have been my depreciation in the current year. Do you agree? Now, I want to change the depreciation method. So if I change the method and I move to new says I want to go back to straight line. If I go back to straight line, this was my balance at beginning of year. I'm only going to change this year. I'm not going to change the past. Yeah, I'm not going to go restate depreciation for all those years. This was my balance at beginning of year, 512. How many years of life did I say were left? 8. 8 years of life remaining. So depreciation would be 512 divided by 8, 64. The change in estimate is the difference between 64 and 102.4, which is a change in estimate. Easy to do? Very easy to do, isn't it? So I do old. The numbers don't work? I do old to get me to beginning. 512 divided by 8? No? 102.4 minus 64. It can't be 30. Is it 38? 38.4. No, it's not your fault. Everybody is supposed to be checking, including me, but I'm writing, so you guys should be checking. All right, so old depreciation using reducing balance method, which is what they decided to do at 20% per annum, got me to 512 at beginning of year. They decided to change the method to straight line. When they decide to do that, we change the current year. We haven't yet presented financials. Do you agree? We will change for the current year and present financials accordingly. So if they had not changed, old would have been 20% of 512, 102.4. Because they've changed, we've decided our remaining life on this asset is 8 years when we looked at the original life and where we are today. And so the new depreciation is 64. The change is 38.4. Easy to do? Easy to do. Let's have a look. Where's my... Okay, can't do anything. So this is accounting policy notes. You would never be asked in an exam for accounting policy notes, maybe at honors level. Here it is. Depreciation. Here's the profit before tax note. The profit before tax note shows depreciation. First year work. And it shows depreciation for the previous year of 128, which was what we had worked out. Am I correct? And for the current year, it shows the new depreciation of 64, because that was what I changed. And then here's the story. Remember I said to you that we need to see 3 things in the story. We need to see a descriptive. Included in depreciation is a change. And the change is a decision to depreciate machinery straight line instead of reducing balance. Yeah? Then I said to you it needed to talk about the effect. The change is 38,400. Sometimes I like to see where it's actually telling me whether it's an increase or a decrease in depreciation. But sometimes you see the note just like that. I suppose you can see that the number dropped, if you just look at the depreciation. But when it's all mixed up with all other assets, sometimes you can't. So I don't know, I like to see where it says included depreciation is a change in estimate or an increase in depreciation as a result of change in estimate. In this case, a decrease in depreciation. Anyway, so there's the descriptive, there's the amount, and then here's the amount in future periods. This change will result, and you see here they talk about an increase of depreciation in future periods of 38,400. Do you agree? By the end of the life of the asset, I will have depreciated fully. So if this year I've depreciated less, it means there will be years where I will now depreciate more. Yeah. So with depreciation methods, with changes in life, that number and this number will almost always be identical, because whatever I've done, I've just accelerated or slowed down in this year, isn't it? And then it's going to be caught up or made up later. Easy? Easy. Change in accounting policy. Change in estimate. They talk about the tax. I can show you the tax. But what's going to happen for tax is nothing, right? Because we have 512 and we're going to take off 64. But SARS is still going to do 20% reducing. So he's still going to say 512, 102.4. And then we're just going to have deferred tax, isn't it? Remember I said to you it's a non-event for tax. SARS is going to carry on doing what he's done. You'll never see a change in estimates, I think, where SARS will accept your change. Because management estimates bounce up and down, isn't it? Then one year it's this and the next year it's that, and then you change your mind again. And maybe your warranties are poor for a certain product, but then you fix the problem and then the warranties get better again. You know, the management estimates keep changing. All right, that's it. I don't think any of these other calculations are really valid in any way, shape, or form. When we get to your assignment, which is right at the end, sorry, there's all kinds of errors and stuff in between. When you get to your assignment, which is right at the end, they asked you to do notes. Am I right? Oh no, this was multiple choice, this one. Yeah, this one was multiple choice. Lekker. Those are easier to do. We're looking at, I think, note 2. No, note 1, I think. Yeah, note 1. Machine delta This is our change in estimate. This over here was our change in accounting policy. Change in estimate. Machine Delta is used to package fruit juices sold by Glow. Machine Delta was acquired 1 January 14. Our year end is December 15, by the way. So this is prior year, beginning of year. Because end of year is December 15. End of year. Machine Delta was acquired 1 January 14, so 2 years now, or 1 year up to beginning of year, and is depreciated straight line at 25% per annum. 25% per annum, I always like to reduce it to years. Straight line at 25% means it's 4 years. With no residual value, great. After a review of the draft, and they say which is similar to SARS, SARS is also allowing it over 4 years. After the review of the draft annual financial statements, the directors decided to change the depreciation rate to 5% straight line and the residual value to 50,000. So management changed the residual and they changed the percentage. This will give a more realistic reflection of the annual pattern of economic benefits derived from Machine Delta. Depreciation on Machine Delta for the current year, provided straight line 25, has already been recorded in the accounting records. The effect of the change has not been recorded. The carrying amount of the machine at beginning of year was 712,500. So they've actually done the carrying amount calc for you. You know that one that I did. They've done it, although in this case it was an easy one because there was only 1 year of depreciation, isn't it? So they just took, oh no, that's because we don't have a number. We had to work backwards. Let me see if Machine Delta is up here. Oh, here it is. Machine Delta, here's the cost. And there's the ACDEP. Remember the ACDEP is 2 years because they've already put through the old. Now what you're going to do is a correction. You're going to correct the number. Okay, let's have a look so you're going to do the calculations, old, new, change. Yeah, there's just one thing that's worrying me, but I think I'm over complicating it. I'm not sure if we're supposed to go back to the beginning and say that the original life changed. But I think we'll just assume that it's from here on that the life will change. So I think you must just from here on depreciate at 5% then, whatever value you get. So if we look at the multiple choice questions, let's just see which ones we can answer, so that you can go and do those. Okay, question 1 is Machine Delta. Question 2 is Machine Delta. Question 3 is Machine Delta. Question 4 we did last week. Question 5 we did last week. Question 6, 7 we did last week. 8 as well we did last week. Okay. Question 9 and 10, is that how many there are? Question 9 and 10. 9 is to do with the error. 10 is to do with framework. So those ones we won't be able to do. So 1, 2, and 3. I'm going to leave you to it. 1, 2, and 3.
Works out to 33,125. 33,125. So when you take 33,125 off the 7,12500, you get 4. The change in estimate, if they had asked you for the change in estimate, the old would have been straight line, right? Would have 237.5. So the change is the difference between those two, 204,375. Although they didn't ask you for the change, that's probably what you would have calculated first. If they had asked you to do journals or something like that, that would be your journal. Do you agree? They've already put 237,500 of depreciation into the books. We would reverse 204,375 of depreciation if they asked you for a journal. So we would credit depreciation, debit and debt by that amount to make the depreciation smaller. The tax base of the machine. What have you got? Number? One. Yeah. Because SARS was doing the same thing we were doing. So SARS would have started with 712,500 and would have taken 237.5 off and been left with 475. Halfway, isn't it? Or the way that I like to work out tax base, 950 over 4 years, 2 years left. Yeah? 950 allowed over 4 years, 2 years left of amortization, wear and tear. So that's number 3. And then number 4, number 3. That was number 2. Number 3. Number 1. Yeah. This one I have gone through with you on the board. What are we not going to do? We are not going to do prior year, isn't it? We don't go back to prior year for changes in estimate. But we will disclose the nature of the change. We will disclose the amount of the change for the current year. We will disclose the amount of the change in future periods if it's practicable to do that, or a statement that it's impractical to do that. They use this funny word, impracticable. I don't even think it's English. It's actually looked it up in the Oxford Dictionary. But basically that's where I was explaining to you that if we change something like the inventory obsolescence, it wouldn't be possible for us to determine what the impact would be because we don't know what the balance is, isn't it? Right. So that is changes in estimate. The next one that we're doing today is errors. Errors. And sometimes this is called prior period errors. When we find in future years that there's been an error in the financial statements of the previous period, we can correct that error. And the rule is correct the error when it occurred. Correct the error when it occurred. That's the rule. So, you know that machine that we had bought 3 years ago? If, for example, we had incorrectly written it off to repairs and maintenance instead of capitalizing it, we would go back and fix it 3 years ago. We correct the error when it occurred. But the reality of this is that in the statement of financial position, we only go 2 years back. So we wouldn't go beyond that, but we would work out what would the balance have been if it had been correct 2 years ago and put that in, isn't it? And then correct the prior year. Sorry, only the prior year. Statement of comprehensive income is only 2 years. Not 2 years back, only 2 years. Statement of changes in equity is 3 years. The other very, very important thing, and this is really an NB. Errors cannot occur in current year. Whatever error you've identified, even if it has a current year impact, it can't be an error in current year. We haven't yet issued financial statements. How can something be an error if you haven't issued financial statements, isn't it? So errors cannot be errors if you haven't issued financial statements. So, errors we will correct back to when the error occurred.
That's the rule for errors. Remember our three that we've looked at and the different rules. Changes in accounting policy, we correct retrospectively forever, isn't it? Remember I said forever, but we're only going to go back 3 years. Changes in estimate, we only correct prospectively this year. Errors, we correct when they occurred. So it could be back, it could be just last year, but errors can never occur in the current year, because we haven't yet issued financials. So if there's been an error in the current year, you can fix it before you issue financials, and so we don't disclose an error. Yeah. So when we find errors and we go back to disclose them, really what we are looking at disclosing is beginning of year or prior year, let's say prior year, and beginning of prior year and prior year. So in our statement of financial position, all we will correct is the prior year. In the statement of P&L, all we will correct is the prior year. And in the statement of changes in equity, we will correct the beginning of the prior year and the prior year. So those are the corrections we will make. But I'll go through examples with you. Errors usually are the ones that students hate the most, because errors can really be anything. It can be anything. And so when you're doing the calculations for errors, what's important is that you identify old, what happened, what entries were made, what balances were there, and you identify new entries, new balances, so that you can work out what the change is. This is the change. So when we have errors, it's very important to figure out what happened. So for example, if I wrote off an asset as repairs and maintenance, there would be no balance in financial position, and there was a year, I'm not sure which year, I'll have to go and see when the expenses were too big, isn't it? And maybe SARS even gave me a repairs deduction, a deduction for repairs. Now I'm going to correct it. Now what am I going to do? That expenses won't exist anymore. I will have a balance on SFP, and I will have depreciation, and there will be tax implications on all those numbers. Yeah. So in terms of calculations, it's still the same old, old, new, what happened, what should have happened, what's the change. In terms of disclosure, the disclosure for errors is very similar to the disclosure for changes in accounting policy. So a change in accounting policy, if you remember, we had a note that was descriptive. We described the note. A note that described what happened, the nature of what happened, and how we accounted for it. Yeah, so that's what we'll do with errors. We'll give a descriptive note. What happened? How have we accounted for it? Have we been able to do it retrospectively? Have we been able to go and fix from when it happened? And then, if you recall, we then had a note that had effect. And our effect was on P&L and tax and SFP and tax. Do you recall that? And we talked about whether it was increases or decreases. Over here. You remember? We talked about whether it was increases or decreases in the P&L and SFP balances. And remember that for changes in accounting policy, we had 3 years. Do you recall? Now, for errors, we will not have a current year column. Yeah? So I'm going to just put a cross here. No current year. For errors, what we will have is we will have prior year and prior year. That's what we'll have. And for prior year, all we're going to have for prior year is that retained earnings. Remember, we had that retained earnings beginning adjustment, which goes into this column. over here into prior year. So all that we will have for errors is a prior year and a prior year column, no current year column. But otherwise, the note for errors looks very similar, almost identical to the note for changes in accounting policy. Okay, let's talk tax quickly. For tax and errors, we have two situations. SARS reopens, and usually for errors, if it is in SARS's interests, they will reopen your assessments. So in other words, if you had written off an asset and SARS had given you the deduction, SARS will say, no, let's reopen that, you owe me, isn't it? SARS reopens the assessments. If SARS reopens the assessments, we will have current tax. Do you agree? Because SARS has reopened and we now have current tax, accounting is equal to tax. If SARS does not reopen, then we will have deferred tax, because then we will have differences that will eventually sort themselves out, but haven't yet sorted themselves out. So if it's a mistake with inventory, for example, SARS might say, no, I'm not going to reopen. But what will happen is that the next year, it will roll through. Do you agree? SARS's opening inventory will now be different to yours because you've adjusted yours, and it will roll through. If it was, I don't know, let's say it was a problem with VAT. You included VAT in your sales. SARS might say, no, I'm not reopening it, and then the next year it will just flow through. You can just flow it through. All right, but usually for errors, we get this situation where SARS reopens, for mistakes that were made in the financials. All right, let's have a look. The example that you have is example 3. It's on page 80. Cirrus Limited. The following information is available for Cirrus. Okay. Here it is. After the financial statements for 31 December have been published, the directors of the company discovered that machinery to the value of 50,000, which had been purchased in July 11, had been expensed instead of capitalized. The bookkeeper had incorrectly stated that the check was made out to BKN Electrical Supplies, a supplier from whom we purchase electrical components. And the check was posted to materials purchased. It's sitting in cost of sales. Do you agree? The company makes use of periodic stock taking, and no adjustment has been made in the books to date. The company depreciates machinery at 20% per annum straight line. Okay, so remember our adjustment. Our adjustment is, there's a bit of space down here. Our adjustment is not for the current year. I'm never going to disclose that as an error. Yeah, my error occurred in 2011, which is prior year, because my current year end is 2012. Yeah, and if I look at old and new, old was that in 2011 I had cost of sales which increased by, what was the amount? 50,000. Do you agree? If I look at new, what I should have had is I should have had PPE cost of 50. Then I should have had accumulated depreciation of 20% for half a year, which is 5. Agreed? It was bought the 1st of July 11. I would have depreciated it for a half a year, for 6 months, at the depreciation rate, which they said was 20%. And I would have had a depreciation expense of 5. The tax implication of these numbers, the tax implication here was 14. Tax drops by 14 on that side. Do you agree? And on this side, the tax implication is 1.4. Tax and deferred tax. Agreed? Okay. So that's your error. Remember I said to you what we will do is we will look at the change. But can you see that our accounts are completely different from each other? So our change is actually fairly straightforward. I'll show you in the note. Prior period error. Here's the note. Correction of error in respect of machinery purchased being expensed instead of being capitalized. The nature of the error. The effect of this error is as follows. Decrease in expenses. Oh, okay, so they put cost of sales and depreciation. I would have put cost of sales separate to depreciation or to expenses because it shows separately in your P&L. Yeah, I wouldn't have just put it as expenses. But they put a decrease in expenses of 45, isn't it? Cost of sales needs to drop by 50 because it was too big. Depreciation needs to go up by 5. So it's a decrease in expenses because the drop is bigger than the increase. Decrease in expenses, 45. Increase in tax expense, the 14 and the 1.4, the two numbers that I had. 12.6. Increase in profit, 32,400. Increase in the machinery account. Again, I probably would have said increase in machinery cost, increase in accumulated depreciation machinery, right? I would have said that. They've done a net 45. Remember, it was 50 and 5. So they've done a net increase in machinery of 45, and there's the deferred tax. They say current tax. Did they say SARS was the same? Is that what it said in the question? Usually with machinery, it's always deferred. Sorry, I didn't even read what SARS had said. SARS will issue a revised statement. SARS is in agreement with the policy. Okay, so SARS is in agreement. They will issue a revised statement. So it's current tax, isn't it? Sometimes with assets, even if SARS agrees, it could be deferred because if they have a different depreciation policy, it will be deferred. All right, so when SARS reopens, they will reissue the assessment and their policy is in agreement with ours, then it's current tax. And so when you look at the note, which you remember from last week is important to make sure that you get right, then this over here is current tax too. You'll see that we don't have a 2012 column because we will never have a 2012 column in an error note. You'll see that we don't have a 2010 column, and that's because the error did not occur in 2010. Okay, let's look at one more example. The next example I have, what is this now? It's the same thing. No, it's this one. Sword. The next example starts at the bottom here. Is example 4. Page. Example 4 on page 85 has all three of the different types of adjustments: accounting policy error and prior estimate. But I just want to deal with the error. We can look at the three. The first one is a change in accounting policy going from weighted average to FIFO. Yeah, weighted average to FIFO. We did a couple of these last week. There's your numbers, increases or decreases, isn't it? The movement is your cost of sales. They said SARS will not reopen the previous years of assessments, but will accept the new policy. So what that means is that for prior years we have deferred tax. For the current year we have current tax. Then number 3 is our error. I thought there was also a change in policy. A change in estimate. No. Number 3 is our error. During the current year, the accountant found a batch of sales invoices that were not processed due to misfiling to the value of 90,000 Rand for the year ended December 11. So again, for last year, there were some sales invoices that were not processed because they'd been misfiled for 90,000 Rand. The sales invoices were filed in the order pending file instead of the sales invoice file. However, the cost of sales had been taken into account. The effect is considered material, and SARS has reopened this assessment. This is not a difficult one, isn't it? Remember I said to you we should try and figure out what was old, what is new. It's very easy. Old was nothing. They didn't do anything. New is they should have posted it, isn't it? Chances are that it should have been posted to receivables. Do you agree that's where sales gets posted to? So the entry that should have been posted would have gone to receivables. I'm not sure if they, and remember what happens with VAT. What happens with VAT is that your sales doesn't include the VAT, but your receivable does include the VAT, isn't it? Because this is how a VAT entry works. You guys have done it in tax? So the VAT, the way that the entry works is that your sales will be 100. It will be a credit. Your debit side goes to debtors, but it's for 114. Yeah? Because you owe SARS for that VAT of 14. Yeah? So sales will be in your P&L. You'll raise the debtor for 114 because that's what he has to pay you, the full amount, but you will raise a credit for VAT payable. Yeah, VAT output for the 14. All right. Let's have a look at the note for this one. Prior period error. Sales invoices which were not processed due to misfiling were corrected. The sales invoices were in the order pending, whatever. In this one's a better note actually than the last one, because look what it says. The comparatives have been appropriately restated. So remember I said to you, our descriptive needs to talk about the nature, and it should talk about how you've accounted for it. So here they've said it's been restated appropriately. The effect of correction on results is an increase in sales of 90 and an increase in tax expense of 28%. And then an increase in debtors of 90 and an increase in current tax due of 28%. I see they didn't put the VAT in. I probably would have put the VAT in. Yeah. I would have put debtors at 114 and a VAT payable at the 14. Well, not 114. 90 plus VAT, and then the VAT piece as a VAT payable. That would have been more correct. But maybe they don't expect that you maybe know that at this stage. I'm not sure. All right, so that's a prior period error. We have an error in our assignment. And we only have one question, and the question is a journal. The journals to correct the error, if I'm not mistaken. Let's have a look. It's question 9. Question 9 says, assuming that the comparative can be reopened to record this journal, what journal would be recorded for the year ended 2014 to correct the misallocation of performance bonuses? So what is the correction error, the correction journal? Correction journals are horrible to do. In practice, the way we do correction journals, and you probably know, is we back out the incorrect journal and put in the correct journal. Yeah, so if there was something wrong, like with that cost of sales that we saw earlier, right, that should have been gone to machinery, I would have just taken it out of cost of sales first and then put the machinery in and not try to do a net entry for the 45. I would have taken out the 50, put in the 5 to show that the correction was 45. Yeah? But when they do it here, they expect you to just do the correcting piece. So they don't want you to back out what was done and put in what's new. They want you to do the correction, from old to new, the movement from old to new. All right, so during the current year's audit, it was discovered that performance bonuses of 120,900 paid to the customer service department staff in the financial year ended 2014, previous year, were incorrectly debited to the accounts receivable account of Glow Limited. The salaries and wages account in the P&L for the financial year ended amounted to 810,000 Rand. The tax effect of the above misallocation is considered material, and SARS has indicated that they will reopen this tax assessment. Okay, so try and figure out what was old, what was the journal entry they posted when they paid these bonuses, what was the journal entry that they should have posted when they paid these bonuses, and what is the correction. Okay, I'm going to start here. Which one do you think it is? 2. Gita, which one? 5, 2, 2, 2, 2, 2. Okay. All right. So I think both of them are correct to a point. And Nikita, the only reason yours is incorrect is because they've asked you to say what the journal would have been if we could go back to 2014 and go into those set of financials. Okay. So if we were making the adjustment in 2015 and we were making an adjustment that related to 14, the entry would go to retained earnings. Do you agree? But because they've specifically said, for the purposes of this journal, assume that the comparative period can be reopened and we can go and record the journal for the year ended December 14. So I know that some systems do allow you to go back to an old period and actually post journals. Does yours allow that? You can reopen it and go in and post a journal, even after you've closed it, and then you close it again. So, but I know that some don't. Like SAP, for example, doesn't. Maybe it's a setting. Maybe some companies have a setting where once you've closed, and any adjustments that need to be made now need to be made to retained earnings. Yeah, and I know that, and the reason is also that if you've prepared financials and then you go back and reopen, then you're going to have mismatches, isn't it? So I know, for example, at Coke, when the auditors have adjustments to financials, which happens now, they're busy finalizing financials now, and now is Feb or March, but they closed the second week in January. When the auditors now have adjustments, we process the adjustments to retained earnings because there is no other way for us to process the adjustments, isn't it? So the correct one, if we could go back and adjust, is number 2. We're going to make salaries bigger and we're going to make the tax expense smaller. Yeah, tax is always the other way. So there's P&L going opposite ways. And then we're going to make our accounts receivable smaller and our tax in our financial position smaller. Yeah, we owe less tax. If we weren't able to, then that would have been the correct entry, which would have taken the 2 P&L items straight to retained earnings. Yeah, and otherwise it's the same, do you see? All right, so that one is number 2. Let's just finish it because we're done, right? We just have 10 to do. Sorry, this looks really awful because I was in dual view mode. Full screen. Okay, so for this one we said the answer was 2. If we look at number 10, I think it's a really easy one because it looks like second year work. Which of the following measurement bases, and we're going to look at framework next week, which of the following measurement bases could be used to account for the warehouse racking acquired in 2015 in the annual financial statements according to framework? Framework has 4 measurement bases, 4 of them. See if you can see which ones you think they are, if you remember from second year. Which ones sound right to you? Historical basis. Who says that that sounds like it could be? Historical cost. Is that something that you think would be in framework? Yes, okay. Current cost. Think that would be in framework? Yes? Sazi says yes. Some people are saying no. Market value basis. Some are saying yes. Okay, so some are saying yes to that one. Present value basis. Present value, we ever use present value to account for things? We discount it back to today? No, yes, we do. Net realizable value. What I can sell something for. How do I value inventory? At the lower of cost or realizable value? Inflation value basis. No. Future value basis. No, okay. So anything with an F or a G is out. That one's out. That one's out. Okay. Then, we're fairly sure about A, am I right? Historical. So that one's out. All right, so we've got ABC or ABDE. So it's not including, so both of those have a B. Do you agree both of them have a B? So through a process of elimination, A and B. And then one includes C and one includes D and E. So which one are you going to go for? The one that includes C or the one that includes D and E? D and E, this one. Okay. The framework, in fact, does not talk about market value, does not talk about inflation adjustment or future value. It does talk about historical and current. Current cost is market value, but the statement talks about current cost, not market value. And I suppose market value really is almost like realizable value. It's what you can sell something for, isn't it? The statement talks about realizable value. And the statement does talk about present value. Those of you that are doing FAC3701 know that we talk about valuing assets that we defer payment on at the present value of the amount, isn't it? I've even went through an example with you. So that one is that, number 4. Okay. Are you packing up? It's early, isn't it? Yeah. So we're going to practice a question. You guys have any material? Tat letter like 102? Nothing? Okay. I will go make a copy for you then of a question. Actually, let me see. I can put it up on the board so long. Yeah. 45 minutes? No, you can't go 45 minutes early. You can go 10 minutes early, but not 45 minutes early. 15 minutes early.
We'll have a class discussion.
What do you want to have a class discussion about? You know what you can do? Let's just see. Okay, so this is the first one that I want you to look at. It's a change in estimate, but it's a different one. File, print, current page to smartboard. Print. Okay, there we go. I want you to do the note for me. That will appear in the profit before tax. I will go make a copy for you. So I want you to practice that one, a change in estimates, and then I'm going to find a hard change in an error for you to do. Okay, so this is a change in estimate for warranties. Remember I said to you that can also be a question? It is you will get a TUT letter a little bit later in the year, or it should be coming. It's probably available on my Unis already. TUT letter 104. TUT letter 104 is integrated questions. It's past exam questions. So this is a past exam question where they asked you to disclose this in the notes, in the profit before tax notes. I can actually show you for how many marks. Question 2. Disclose additional information 1, 2, and 3 in the notes for 10 marks. Sorry, for 27 marks. 1, 2, and 3. 27 marks. If we look at what 1, 2, and 3 are, 1 is an error. During the current year, they found an error. But this error, the reason I didn't give it to you to do, it looks very similar to the one that we had done in the assignment, because it's expenses of 120,000 Rand that should have gone to security services that landed up in accounts receivable. So it's almost this, it's the same number even, isn't it, as the one in our assignment question. Okay, so that one, that error, this change in estimate, and then 3 is a provision for damage to a warehouse because of unfair that was done. I think it's something like that. So 27 marks, you can see, is quite a lot, hey? But this is the one that I want you to do for me now. The change in estimate. I will go and make copies for you. But as I said, it will be in that TUT letter when you get it. TUT letter 104. So I want that profit before tax note. Okay, let's have a look before our time runs out. So this first one is the error. The error was that there was 120,000 in receivables that should have been expensed. The one in our assignment was salaries, so salaries usually would just go straight to P&L, isn't it? But this one is not salaries, this one was for security services. And it should have been an expense for security services of 120, and instead of debiting the security services, they debited the receivable. So the receivable must drop, isn't it? That's a given. They didn't say anything about VAT, so we ignore the VAT. But when we look at this expense for security services, we see that it's from November to October. So our year end is Feb, which means that the amount that should have landed up in expense is only 4 months. November, December, January, February. 4 months. The other 8 months would have been a prepaid for the current year's expense, isn't it? Because it was from November 09 all the way to February 10, 4 months would have landed up there. The other 8 months will land up in the current year's expense. But we're trying to fix the prior year. Remember, errors can never occur in the current year. So our fix will be reduce accounts receivable, increase expense, increase prepaid. Yes? The next one down here was the change in warranty. It was a big story, eh? And I'm sure you're all going, what the hell? I didn't know what was going on. But it was a big story. And essentially their story was that currently their provision for the warranty is 100,000 Rand in their books. And the estimates are that 80% of tires will have no defects and won't come back. 15% will have minor defects, and 5% will have major defects. But when they looked at their quality control surveys that they'd done, they found that actually the returns are a bit different. 90% don't come back, 6% come back with small defects, and 4% with major defects. They also have had a look at their records, and according to the surveys, if minor defects are detected in all tires sold, if all our tires had minor defects, the cost would be 400. And if all our tires had major defects, the cost would be 800. But we know that 6% of our tires have minor, 4% have major. So the actual cost will be 24 plus 32, 56. So our provision that we will adjust, we're going to adjust from 100 to 56, will result in a change in estimate of 44, a reduction. We won't be able to estimate what the impact will be in future because we don't know how many tires will be sold in future, isn't it? So we don't know what the impact will be of repairing all tires. So they asked you, I showed you in that required 27 marks for the notes for number 1, 2, and 3. 27 marks. I'll show you exactly what makes up the 27 marks so you can see. The beginning of the 27 marks is the profit before tax note. It's the warranty provision. It's the change in the warranty provision that lands up in the profit before tax note. Included in profit before tax is a change in accounting estimate that arose from the decision to change the estimates used as a basis for making the provision for warranty costs due to the results of recent quality surveys. The change in estimate resulted in a decrease in provision of warranty claims of 44. Remember when I was showing you the other notes, I said to you, I think I would like to see whether it's increasing or decreasing. A decrease in the provision of 44. The cumulative effect of this on future periods is unknown. It is unknown because we don't know how many tires we'll sell. If we stop selling tires, it will be zero, right? Okay, so that was the first piece of the disclosure that you were required to do. And remember, it doesn't ask you for the specific note. It just says disclose those items. So you were supposed to have identified that it was a change in estimate, in fact, and then you were supposed to have done the correct note for it. If you did a change in accounting policy note, no marks and a lot of work. Then the prior period error, correction of security expenses incorrectly accounted for as debtors. The comparative amounts have been restated. Remember the two things I said you needed to put: the nature of the error and how you've accounted for it, and the effect of this error. And remember, once again, we're just sitting with a 2010 column, not the 2010, because we can never have a current year column in an error note. And what is the effect of our error? An increase in expenses of 40. A decrease in receivables of 120 and an increase in prepaids of 80. The net effect here is 40, there is 40. It needs to balance. P&L balances our balance sheet, isn't it? That's how it balances. And then the tax effect is that if I increase expenses, my tax drops. And if my tax drops, then my SARS will drop as well. And there's my effect. So there's that note. So the 27 marks are those two notes, and then stuff we haven't yet done. A provision note for the one. Okay, it's a bit of work. Yeah. And then 3 small notes that are just stories. Events after reporting period, contingent liability, contingent asset. 27 marks. So I mean, even if this is, say, 2 and 2, 4 marks, and this is maybe another 2, 6 marks, yeah, and maybe this note here could be, I don't know, 7, 8 marks, 9 marks, even if it's 10, 16, it still means that the rest of this is like 11 marks. It could be more, isn't it? It could be 15 marks for those bits, those 2 bits. The work we've done so far, tax and changes in accounting policy, is about 2/3 of your paper. Because what we have left is small things. Next week we're going to do framework. Framework is about 7 marks in the exam. Then we're going to look at provisions. Provisions is just in your notes, so it's maybe 10 marks at most. And we're going to look at events after reporting date, which you saw here, contingencies, all small marks. Fair value also 5, 7 marks. The rest of it is small marks. The big marks is the stuff we've done. And every paper will have a change in policy, a change in estimate, and an error in the different questions. In this question 2 of this exam paper, there were these 2. In question 1 of this exam paper was a change in accounting policy. Okay. So next week is an easy one, framework we're going to do, and it's just all theory, and we're going to practice answering theory questions. By the time you progress and write board, theory questions can be 30 marks for a theory discussion question. But we're going to start in 3rd year. Our theory discussion questions are about 7 marks, small marks. Okay.